Good morning. Welcome to the Property Tax Legislative Update Webinar 2. My name is Cynthia Rowley, Property Tax Director at the Department of Revenue. And on behalf of Revenue, I'd like to welcome you all. To those of you that participated in our first webinar in August, welcome back. And for those that are joining us for the first time, we're glad you're here. On your computer screen, we'll be walking through some different information. You may need to periodically wiggle your mouse to avoid the screensaver kicking in. Your microphones should be muted, and this will eliminate any background noise and help facilitate the webinar. Your phone line should remain muted throughout the call, but you can communicate with us at any time using the chat function. That's part of the webinar, and we'll talk about that again in a few minutes. Several topics will be covered today. We have included answers to questions you submitted ahead of time whenever possible. And at the end of each topic, the presenter will allow some time for you to chat your questions and provide an email address where you can ask additional questions after the webinar. Your feedback from the first webinar resulted in some changes for this second one. You said that some of the speakers were hard to hear, so we're using new techniques and equipment during this webinar. And I encourage you to use the live chat option at any time if you are having difficulty hearing a speaker. You said you wanted more opportunities to ask questions. Several changes were made from this feedback. First, you were again asked to submit questions about the topics for the webinar ahead of the session, so those questions could be answered if possible during the webinar. And second, we're adding a 5-minute or up to 5-minute window at the end of each topic, so you can send us questions via the chat function. As the presenter is nearing the end of the topic, they'll remind you to submit your questions about that topic. So to send us questions using the chat, you would first click on the green chat icon on the top right of the screen. The arrow's pointing there. Next, that will cause the chat box to show up, and right above that chat box it says send to. Please make sure to select Michelle Kluge in that box, and then type your message into the chat function. We will answer as many questions as possible during that 5-minute window today, and if we don't get to your question during the session, it will be addressed in a written Q&A after the session. So we'll include the questions we received beforehand, the ones we answer that are chatted in during the webinar, and any we don't get to in a written Q&A after the session. And once again, at the end of this webinar, you'll be asked to take a brief survey. Please take a few minutes to let us know your thoughts. Your feedback is important to us, and it is used to make the process work better for all of us. The 2017 tax bill contained about 125 provisions that relate to property tax. It was a culmination of proposals worked on in the last 3 years. And over the next hour and a half, we'll share information about several of the 2017 legislative provisions that are already effective or will be soon. Additional information will be shared about provisions that are effective later as the time approaches. Here at Revenue, we've assembled our colleagues who are knowledgeable about the topics listed. We'll go around the room here and have each person introduce themselves so you recognize their voice. They'll share what they do here and what topics they'll be talking about during the webinar.
Hello, I'm John Van Derden. I'm the State Assessed Property Supervisor here at the department, and I will be talking about income tax or income property tax assessment data.
This is John Kloxeem. I'm the Assistant Director for Assessment and Classification, and I will be talking about local conservation easements as they relate to agricultural purposes, and then also change to Class 4BB Condominium-type Storage Units.
And this is Emily Anderson. I am the supervisor of the Information Education section here at Property Tax, and I will be discussing the remaining topics on the agenda today. So I'm going to start off sharing information today on the changes made to the reporting requirements of revocable trusts and what that means in relation to approving agricultural homestead. A new law made changes to Minnesota statute section 500.24, which is the statute that covers farming by business organizations. Specifically, the new law amended subdivision 4. This section in law lays out which entities are regulated and must be authorized to own and farm land in order to qualify for homestead. This new language states revocable trusts do not need to register with the Department of Ag. If you've ever taken a training given by the Department of Revenue staff on agricultural homesteads or referenced our Property Tax Administrator's Manual, in the past we've always said the type of trust, whether it's revocable or irrevocable, is not of importance because all trusts, regardless of type, were required to register with the Commissioner of Agriculture. County assessors then simply had to verify if the trust was registered before granting the agricultural homestead. The registration requirement has now changed, and with that change, our training and guidance will change as well. Assessors will now need to verify the type of trust to determine if the trust is required to register and whether homestead can be granted or not. The effective date for this provision was August 1st, 2017, but we wanted to discuss this provision during this webinar as agricultural homestead application deadlines will be coming up in December. Also, just to be clear, entities including corporations, limited partnerships, limited liability companies, and other trusts such as irrevocable trusts are still required to be registered with the Minnesota Department of Ag, or MDA. By filing the Minnesota Corporate Farm Application prior to purchasing or engaging in farming of ag land. The new language only states revocable trusts are no longer required to do so during the time the trust is revocable. So for your reference, a revocable trust is a trust created to handle the grantor's assets, often called a living trust or inter vivos trust, which only becomes irrevocable on the death of the grantor. So this is the time, there were no questions submitted prior to the webinar, so this is the time if you do have questions on this topic, please chat them in now. Again, selecting Michelle Kluge as your person to send them to. We'll wait about 30 seconds to see if there's any questions. We have set aside about 5 minutes to address all the questions we can, and we'll start with those most commonly asked. Okay, we did receive one question. The question is, if a grantor of a revocable trust does pass away, does the trust become irrevocable? So I had mentioned earlier, as doing a little bit of research, is that in language that once the revocable trusts are no longer, is that it only becomes irrevocable on the death of the grantor. And so this is something that we will do more research on and answer the question. Just at this moment, that was the research that I have done. Okay, there doesn't seem to be any more questions, so we will move on to the next topic. Oh, first of all, there are more information that we would like to share with you, that in the past there was some confusion regarding the types of entities that must register with the MDA in order to receive homestead treatment on qualifying land. So we've included that in the summary of the Property Tax Administrator's Manual. As you can see here, the manual has been updated to show that revocable trusts do not need to be registered with the MDA. So keep in mind that all other requirements for agricultural homestead must still be met for property to be held by a revocable trust to be granted an agricultural homestead. If you do have any more questions that you would like to send to us regarding the trust reporting requirements in regards to ag homestead, please email us at proptax.questions@state.mn.us. Thank you.
Hello again, this is John Kloxeem, and I'm going to talk about a change made this year to the definition of agricultural purposes for Class 2A. As you know, certain state and federal conservation easements, most notably Reinvest in Minnesota, commonly referred to as RIM, and the Conservation Reserve Program, CRP, have been included in the definition of land being used for agricultural purposes, as long as the land was classified as agricultural in the year prior to enrollment. Conservation easements that may have been administered by a local unit of government, such as the Soil and Water Conservation District, a city, or a county, were not included. Now, landowners who enroll lands classified agricultural in a locally enacted conservation easement will be able to maintain the agricultural classification as long as certain program requirements are met. Those include making application by February 1 of the assessment year, providing a copy of the program requirements and a map showing the easement area, along with the specific agreement between the landowner and the agency. In addition, the landowner must receive at least $50 an acre as compensation for enrollment into the program. These requirements help the assessor delineate the area under conservation easement and clarify that local programs are similar in nature to RIM and CRP. This provision is effective for assessment 2018 with taxes payable in 2019. Applications need to be submitted by February 1, which means that the land must have been classified as agricultural in 2017. For the counties, we would like you to have an application available for property owners to apply by February 1st. We did not receive any questions submitted prior to the webinar on this topic. However, if you do have questions now, you can submit them via the chat function. It doesn't seem like we have any questions, so we'll move on. We will have an updated application just distributed to the counties by the end of the month, and that will be sent out via our county official mail distribution list. If you have any questions, please contact us at proptax.questions@state.mn.us. I should also note that this will be a one-time application. Once they fill out the application, as long as the conditions do not change, they will not need to file that application annually.
This is Emily Anderson again, and I will discuss changes to the blind and disabled homestead classification, also known as Class 1B. This amendment is a technical change to clarify county administration of the Class 1B program. It clarifies that the market value of in excess of $50,000 for Class 1B blind or disabled homestead property is classified as either 1A residential homestead or 2A agricultural homestead, depending upon the use of the property. Also, the remaining tiers for either residential or agricultural homestead are reduced by the $50,000 value that receives the 1B classification. We haven't received many questions regarding this provision. However, we have included the screenshot of the updated 2018 class rate table here that explains how it should be broken down, and we will also go over an example of just what this should look like when it is broken down. So let's walk through this example to see. Fred and Wilma are married. Fred is blind, Wilma is not. They own and occupy and homestead their single-family home in the city of Bedrock. The property is valued at $550,000, and because the property is valued more than the homestead market value exclusion limit of $413,800, there is no valuation exclusion for this example. So the appropriate classification for the property would be, as you can see on the screen, $50,000 Class 1B full blind homestead and $500,000 at Class 1A residential homestead, because in this scenario it is a residential homestead. So if we move on to the next calculation example, here it is broken down, you can see. So the 1B classification rate is 0.45%. Please note that the $450,000 that is classified as 1A that is receiving the first tier, because the first $50,000 of value is already receiving the reduced rate for 1B. The remaining $50,000 receives a second tier multiplied by a class rate of 1.25. So this just shows the breakdown of how it would be done. The effective date for this provision is for the assessment year 2018, taxes payable in 2019. Again, there were no questions submitted prior to this webinar, so if you have those questions on this topic, please chat them in now. And as a reminder, please make sure to send to Michelle Kluge when you send in your questions, not the host. So we did receive one question, and that question is, will an updated fact sheet be provided? And that answer is yes. If updates to the fact sheets need to be done, we will provide those and update those as appropriate. Okay, there doesn't seem to be any more questions. So, for more information, the updated 2018 class rate table can be found in the 2017 law summary and also at the end of Module 3 of the Property Tax Administrator's Manual, the module classification. If you have more questions and you'd like to send them in, if you have questions pertaining to the tax calculation, please contact the Auditor Treasurer Services at proptax.admin@state.mn.us. And if you have questions regarding the classification, contact the Information Education section at proptax.questions@state.mn.us.
I'd like to move on now and talk a little bit about condominium-type storage units, which was a change to the non-homestead residential classification 4BB. This year, Class 4BB has gone from one part to now 3 specific parts. The third part allows for condominium storage units which have a separate parcel identification number and are not used for commercial purposes to receive the lower class, 4B. This applies primarily to 2 situations. The first, for example, being a garage that is part of a residential condominium complex in which the owner of the storage unit does not occupy a homestead unit in the complex, and second, a condominium storage unit that are part of a common interest community where the storage uses can be both commercial and non-commercial. Since this only applies to properties within a condominium type, classification treatment is different for residential garages situated on separate lots, which would remain classification 4B1. The effective date for this provision is for assessment year 2018, taxes payable 2019. What we would like the counties to do is verify the use of any storage units on separate PIDs located within common interest communities that they may have classified in the past as Class 4B1. This should now be moved to Class 4BB. If you have any questions you'd like to chat in, please do so now. We did have a question on this as it pertains to ownership within these type of situations. And the question was, can a parcel owned by an LLC be classified as 4BB3? The answer is yes. A condominium-type storage unit owned by an entity such as an LLC would qualify for this classification, provided the unit has a separate parcel identification number and is not used for commercial purposes. Since there are no questions, we'll move on. You can find more information on the updated class rate table, as Emily mentioned earlier, the 2017 law summary and the Property Tax Administrator's Manual under classification. If you have further questions, please contact your property tax compliance officer or email us at propertytaxquestions@state.mn.us.
This is Emily again, and I will now discuss the newly added class rate for the Congressionally Chartered Veterans Organizations. New language for the 4C3 classification reduces the classification rate for the Congressionally Chartered Veteran Service Organizations that qualify as either as Class 4C3 nonprofit community service-oriented organizations. The rate for the qualifying property owned or operated by these organizations changed from 1.5% to 1%. Keep in mind that the organizations must qualify for either 4C3I or 4C3II and be listed as a congressionally chartered veteran organization to qualify for this reduced rate. Per the new language, the Department of Veterans Affairs is required to give the Department of Revenue a current list of congressionally chartered veteran organizations. So that list provided to us as the most current list is found on the House Committee of Veterans Affairs website, which is listed on your screen now. Some of you have asked if a more specific list will be provided, and the answer is no. This is a link that will also be referenced in our Property Tax Administrator's Manual, and unfortunately, we do not have or been provided with a more specific list. The effective date for this provision was for assessment year 2017, taxes payable 2018. So what does this mean for the counties? Counties must verify which organizations are congressionally chartered veteran organizations who are receiving the 2(4)(c)(3) classifications and give them the appropriate class rate. Again, there are no questions submitted prior. However, if you do have those questions right now, feel free to chat in, sending to Michelle Kluge. We will wait for 30 seconds to see if any questions come about. We do have the question of where is the new class rate schedule located, and the class rate schedule can be located in our 2017 law summary and also in Module 3 of the classification module of the Property Tax Administrator's Manual. And then also, for more information, go to the House Committee of Veterans Affairs website, which is www.veterans.house.gov. And then what you're going to do is you're going to find the tab that says Resources, and then in that drop-down menu, find Veterans Service Organizations. Here you will find the list of congressionally chartered veteran service organizations that I referenced during this presentation. So if you have any additional questions regarding this reduced class rate for congressionally chartered veteran service organizations under Class 4C3I and II, please email to proptaxquestions@state.mn.us. And then just for your reference, the screenshot that is on the screen is the list that you can find on that website given. All right, so let's move on to the homestead application. New language was added that requires the Social Security number of spouse of the individual applying for homestead. This refers to if it is the owner of the property or a relative, whoever is applying for homestead. According to this new language, even if the spouse is not occupying the property, the Social Security number is still required. We have received feedback in the past and heard from counties that they wanted to be able to capture the spouse's Social Security number because it would be helpful during the duplicate homestead process. A while back, this information was captured, and when it was no longer required, there were a lot of, well, what now questions, because it made it very difficult to check for duplicate homesteads. So since the passing of the tax bill, we have had the opportunity to instruct in a few conferences, and at those conferences, as well as through our email, we have received some feedback, questions, and concerns regarding this language. We want to thank all of you who have shared those questions and concerns with us, and we will discuss them in the next few slides for all of you joining today. First of all, the effective date for the new language is for homestead applications filed in 2018. We will be releasing an updated application closer to the end of the year since it is not required to use the new one until 2018. We don't want any confusion. We do not anticipate you noticing drastic changes to the updated homestead application. However, the occupant's spouse's information will be captured in its own section below the occupant's information. This is where you'll find the Social Security box for the spouse, which has always been on the application, but the changes will make it more clear. And instructions have also been updated to reflect those changes. Okay, so I will now go over a few questions that we have received prior to the webinar. A question is that if the spouse does not provide the Social Security number, should the homestead get 50% homestead? The answer is yes. So if the spouse does not provide a Social Security number, the property should only receive 50% homestead. We have heard that under the current way of administering the application, that if the non-occupying spouse's Social Security number is currently not on the application, the homestead is already 50%. If the spouse fills out an application somewhere else, that also would be 50%. So the question has been asked, what is different and what is this new requirement solving? In order for this to work correctly, we must assume that people fill out the form accurately and correctly and do not have any intention to deceive or claim a benefit that they do not deserve. This would be ideal. For most people, this is the case. However, in cases where the intention is to claim 2 homesteads, or at least 1.5 homesteads, Until the provision is passed, there is no notification or check that could have been done to alert the assessor for this situation. So for example, if someone had a cabin up north for which one of the couple on the deed and the other did not put their spouse's social security number on the application or check that they were married, how would the assessor ever know that and that they could not receive a full homestead on the cabin? Thankfully, we do think the situation is rare, and most spouses live in the same property, so we do not envision you adding a lot of social security numbers to the duplicate list or applications that you did not have before. Next question is, does a spouse that does not occupy the property also have to sign the application? The answer is no. The spouse does not need to sign the application if they are not occupying the property. The requirement per law is only to provide their social security number. This is also true for owners that do not occupy the property. Their signature is not required. Another question, do we need to go back and get the social security number of spouses for homesteads already granted? The answer is no. The requirement is only for applications received in 2018. And then the question had been asked is if we will provide an updated application, and as I mentioned earlier, yes, an updated application has been created, and we will provide it closer to the beginning of the year as for these homestead applications filed in 2018. All right, so this is your time to submit your chat questions in now to Michelle Kluge. So the first question is, will widow be added to the new application at this time? And this has been something that you have provided to us as feedback over time. And during the new change to the application, we are considering this and has been put onto the application. Our next question is, what if you don't know if they have a spouse? Unfortunately, we only know what we don't know. And with the homestead application format now, there is an option for them to say whether marital status, and we'd hope that everybody follows the instructions of the homestead application. If they had not filled out to in its entirety, there is always a clause at the end of the application that is not, I do not have it in front of me, I apologize, but it could be considered fraud. Okay, so next question that we have is if the non-occupying spouse refuses to put their social security number on the application, does the entire parcel go to non-homestead? The answer to that question is no. The homestead would still receive 50% homestead for the occupying spouse who is at the property and applying for homestead. All right, we'll move on at this time. And so again, an updated application will be coming soon, and the homestead module in the Property Tax Administrator's Manual has been updated to reflect the new requirement. If you have questions pertaining to the duplicate homestead file specifically, please contact homestead.match@state.mn.us. And if you have questions regarding homestead, contact the Information and Education section at proptax.questions@state.mn.us. All right, you get to listen to me one more time, and now we will talk about the new change that is very specific to travel trailer improvements on leased land. So, as mentioned, it is very specific to only travel trailers on leased site. It does not include structures for manufactured homes, sectional structures, or park trailers. Since the first release of the 2017 law summary, there had been some clarification edits to the law summary to make it more clear that the increased value to $10,000 is for storage sheds, decks, and other similar improvements on travel trailers on leased sites, for example, trailer park. For improvements for travel trailers, it is considered personal property and is taxable only if the total estimated market value is over $10,000. If over, the property is taxable as personal property to the lessee of the site if it is not owned by the owner of the site. As always, if property is owned by the owner of the site, it is taxable as real property. The effective date for this provision is assessment year 2018, taxes payable in 2019. So if you have improvements currently listed on the tax rolls for more than $1,000 but less than $10,000, then those improvements should be removed from the tax rolls. So let's walk through an example so that it better explains the change. So if a site contained a deck valued at $7,000 and a storage shed valued at $4,000, then the value of the improvements would be added together and equal $11,000. The entire amount would be assessed. Another example is that if a site contained only a $7,000 deck, however, the entire $7,000 amount would not be taxed because the improvements do not total more than $10,000. Here's the definition of travel trailer found in the Property Tax Administrator's Manual and comes from the statutory reference 168.002 subdivision 36. And so for your reference, it states that a travel trailer is a trailer mounted on wheels that is designed to provide temporary living quarters during recreation, camping, or travel, does not require a special highway movement permit based on its size or weight, then towed by a motor vehicle, and does not exceed 8.5 feet in width or 45 feet in length. So we did receive a couple questions regarding this provision, and the question that we had is this provision only for licensed travel trailers? And the answer is no. It is for improvements on leased sites occupied by travel trailers, both licensed and unlicensed. And this information is found in our Property Tax Administrator's Manual. Another question we've received is asking if the single improvements to the leased site needs to exceed $10,000 to be put on the tax rolls, or if the combination of the value of the improvements. So if you look back at the example that I had given, the answer is that if its combined estimated market value exceeds $10,000, the improvements are taxable. If you have any additional questions at this time, feel free to chat them in, and we'll wait for 30 seconds to see any questions that you may have. Okay, we did receive a question, and if a travel trailer is unlicensed, does it have to be worth $10,000 to be assessed? And the answer is no. So the clarification of this language is only specific to the improvements to that travel trailer. So, for example, decks, sheds, things like that. So we did receive the question of, do you know what page exactly this is on in the law summary? And the page number that I have in front of me is page 14. And so the new title is for travel trailers on, or sectional structured on leased sites. And so we have another question, is that for clarification, this does not apply for manufactured home in parks. And the answer to that question is you are correct. This only refers to travel trailers. Okay, so for your reference, the example that we walked through and the definition can be found in the Property Tax Administrator's Manual. However, if you do have additional questions, you can email us at proptax.questions@state.mn.us.
Hello, this is John Van Derden. I'm the supervisor of the State Assessed Property section to talk to you about income property tax assessment data. The change this year is that certain property tax assessment data for income producing property, including detailed income and expense figures, average vacancy factors, verified net rentable areas or net usable areas, whichever is appropriate, anticipated income and expenses, projected vacancy factors, and lease information, which was previously classified as public data for the state, while it was classified as private or non-public for counties. This data is now private or non-public at the state level as well. This change will enable publicly traded companies to provide their internal forecast to the state for purposes of state-assessed property valuation without the information becoming public. For data classified as private or non-public data, the department cannot disclose information to any third party except as allowed by law. There are statutory penalties for any access to or release of classified information without authorization. The Minnesota Department of Revenue is committed to complying with all applicable privacy laws. This change is effective for data practices requests going forward. Counties do not need to change their practices based on this change. There were no questions that were submitted on this subject prior to the webinar, but if you do have questions on this topic, please chat them in now. We'll wait about 30 seconds to see if there are any questions. Okay, it doesn't seem like there are any questions, so we'll move on. If you would like to look further into data classification, you can review Minnesota Statutes Chapter 13, and this change regarding assessor's data is in Section 13.51, Subdivision 2. If you have any questions about the administrative changes at the state for this statutory change, please feel free to email them to us at sa.property@state.mn.us.
This is Emily Anderson again, and I would like to just clarify an answer I provided earlier, and that was to the question of what page the travel trailer improvements were on in the law summary. And due to the updates, I apologize. The page number for that reference is actually page 15 of the law summary found on our website, and the specific title of that is Sectional Structures, Travel Trailer Improvements on Leased Land.
All right. Well, if you have questions about the provisions discussed today, please send them to us using the property tax contact information here or provided at the end of each topic. This webinar will be made available online for your future reference and for those who could not attend today. The questions you submitted during the webinar will be summarized, answered, and also posted to the web. Please continue to submit your questions on these and other provisions using the contact information on the previous page, and we'll respond as soon as we can. You can also find more information about these provisions and others in the law summary. Use keyword search 2017 Property Tax Law Summary. Our priorities for preparing memos and other clarifying information are being driven by effective date. We'll communicate about other provisions as we near their effective date or the time when you or revenue need to take some action. At the end of this webinar, a very short survey will automatically open. Your response is important, so we know what worked and what didn't with this format. Changes were made based on your feedback from the last webinar, so please take the time to let us know what you think. Moving forward, there are several more webinars planned to cover topics as they become effective or require your attention. The next webinar is scheduled for December 7th, and here are the topics that we plan to cover. A registration link for the December webinar will be sent out in a few weeks. There is at least one more webinar scheduled after that to discuss 2017 legislative changes, and that'll be in the spring. The topics for the spring webinar are listed above. So between those two lists, if there are topics you don't see on the schedule but would find useful for us to cover, please contact Jamie Hopkins at the email indicated on this page. And just be aware that the topics covered in each webinar may change slightly based on the questions and feedback that we get. Thank you to all who participated. Please let us know how this worked for you by completing the survey. And this concludes today's webinar.